The United States has just taken a dramatic step by introducing 100,000 annual fees on each H-1B visa. This move changes the economics of skilled immigration overnight. Companies in technology, healthcare, and finance that relied heavily on this visa to bring in specialized talent will now think twice before sponsoring workers. Instead of hiring abroad and relocating, firms may expand operations offshore in Canada, India, or Eastern Europe, where the talent already lives. The measure also favors only the most highly skilled or revenue generating workers who can justify such a steep cost. At the same time, Washington is opening premium gold and platinum pathways for wealthy immigrants who can pay millions of dollars, signaling a shift from skills-based immigration toward capital-based entry. While politically popular under the banner of protecting American jobs, the long-term risk is that innovation ecosystem, from artificial intelligence to biotech, will suffer as talent pipelines dry up and other countries absorb the skilled workers America turns away. And across the border, Mexico is turning up the heat on Chinese import, announcing tariffs of up to 50% on a broad range of products, with special emphasis on autos and auto parts. The move serves three purposes: protecting domestic industries, aligning more closely with Washington's anti-China trade posture, and building leverage ahead of 2026 USMCA review. For China, this creates a dilemma. Many of its automakers had been eyeing Mexico as a backdoor into the US market. Now, they will need to either set up full-fledged manufacturing plants in Mexico to qualify for trade preferences or absorb the extra cost of tariffs. Some may even reroute their investment toward Brazil or the Middle East, while others might localize production just enough to pass under the rules of origin. For Mexican manufacturers, the tariffs promise protection, but also raise fears of higher costs, especially for industries dependent on Chinese inputs. When viewed together, these two decisions, Washington's talent war and Mexico's trade war, form a broader North American strategy to restrict both the inflow of brains and goods from Asia. The United States is making it costlier to bring in human capital, while Mexico is making it costlier to bring in Chinese products. Companies will now adapt by splitting their operations. Innovation hubs may shift to Canada or India, while Chinese manufacturers will be pushed to either localize in Mexico or look elsewhere. This is selective decoupling rather than complete disengagement. North America still needs global supply chains and knowledge flows, but the goal is to firewall its critical sectors against what leaders see as strategic vulnerabilities. The winners and losers are already visible. Canada and the UK will likely attract the talent that can no longer afford the US route. India will face short-term pain, but could see a surge in offshore centers and stronger domestic job markets. Mexico gains negotiation strength, but risks inflation and Chinese retaliation. Meanwhile, the US may succeed politically in projecting job protection, but risks long-term damage to its innovation engine. For China, the setbacks in North America will accelerate diversification, deepening its trade ties in Latin America, the Gulf, Asia, and Africa. So, the bottom line is the Americas are reshaping themselves into a more close, defensive economic bloc. The US clamps down on people, Mexico clamps down on goods, and the entire region sends a message: if you want to access, you have to localize, invest, and play by our rules. So this was the today's stories for the Eurasian Digital. Thank you for watching. Subscribe our channel to get the latest video.